Okay, let's get started. Welcome everybody. I'm Doug Eakley. I'm co-chair with Arthur Labey, the Rutgers Center for Corporate Law and Governance, and we're very pleased to have you join us for a conversation with Professor Robert Jackson, who is the former commissioner of the Securities Exchange Commission. And Professor Jackson, it's wonderful to have you with us. I'm going to turn the program over to Dean David Lopez for a brief welcome, and then I'm going to introduce the interrogator, my friend and former client, Doug Shaw. Dean Lopez.
Thank you, Doug, and welcome, Commissioner Jackson, and welcome everybody out in the virtual audience to this webinar that's being sponsored by the Rutgers Corporate Center of Governance. This is the latest in a series of fascinating speakers that we brought to the law school, this time virtually, to talk about many of the cutting edge issues in the area of corporate governance. It's really hard for me to imagine a speaker with greater experience in this area, both as an academic, but also as a fellow public servant serving with the SEC. So I welcome you, Commissioner Jackson, and welcome everybody, and turn it back to you, Doug.
Okay, thank you. Doug Shaw is the senior fellow of the Center for Corporate Law and Governance. He's the sole owner and president of Soundboard Governance LLC, and was previously the executive director of the Conference Board ESG Center, and before that was assistant general counsel and corporate secretary of Johnson & Johnson, which is where he was when we first met. Doug, let me just cut it short there and turn the conversation over to you.
Okay, great. Thanks so much, Doug. So we're very lucky to have former SEC Commissioner Rob Jackson join us today for our open session. Rob just stepped down from his stint at the commission in February and joined the faculty at NYU Law School. Before going to the commission, he had been on the faculty for Columbia Law School. Rob is well known as a very outspoken individual and thought leader in the corporate governance and legal field. He has a long and varied career, including in private practice, as well as an investment banker, as well as working at the Department of Treasury, and during the financial crisis. You know, I think that I will leave it at that, but really happy to have Rob, and we're going to go through a number of topics that Rob and I have discussed over the years and have been, you know, very, very prominent in today's world. We'll talk a little bit about ESG disclosure, a little bit about proxy plumbing, and then a topic that Rob has been pushing for quite a few years, the disclosure of corporate political spending. So let's see, I don't see Rob on my screen. Okay. Rob, I think if you start speaking, I'll see your speaker view.
Well, let me just say hello, everybody, and thank you for that very kind welcome. Thrilled to be here. Well, thrilled to be here, but mostly thrilled to be with you and having this conversation with the thought leaders at this terrific center who are working on these important issues. I've been having this conversation with Doug Shaw one way or the other for over a decade. So I feel very fortunate to have been the beneficiary of his wisdom. Everything I am about to say, he is to blame for. But I'm really, honestly, I just learn a lot from talking to Doug. So that's why I'm here. And hopefully I'll have the chance to hear not only from him, but also many of you. I'm very keen to get a sense of what's on your mind and to hear your thoughts about the pressing issues and what is really a unique moment, a generational moment in my humble view, in thinking through questions of corporate governance and how public companies grapple with the hard decisions they have to make.
Great, great. Well, Rob, let's jump into ESG disclosure. So, the commission proposed a number of amendments, kind of an overhaul of Regulation SK and disclosures in companies' annual reports and quarterly reports. And so when it was proposed last year, you had your own comments on this and concerns. And now that the rules were just adopted, 1 or 2 weeks ago, I guess, just knowing what you know and seeing all the comments and having all the feedback, how do you think companies are going to approach these new set of amendments, which are more, I guess more principles based, yet supposed to be more company specific? So why don't you just give us some of your thoughts on that?
Sure. And again, I'm happy, Doug, to have this conversation. And I'm hoping, I think there might be a chance for some questions from those who are listening in, and would love to have those too. But let's first start with this one, because I think it's spot on. It's a really pressing issue. So here's the fundamental question the SEC faces anytime it mandates disclosure. On the one hand, one-size-fits-all rules have well-known downsides. First of all, they don't apply well to particular companies or industries. It's very hard to pick a rule or a metric that applies equally well to the thousands of public companies the SEC oversees. And so if you impose a one-size-fits-all rule, you're going to have costs of disclosure that aren't that useful or that distract investors, et cetera. On the other hand, if you use a fully principles-based regime and just allow corporate management and their lawyers to decide whether and what to disclose, you're likely to get disclosures that are not that helpful to investors because they won't be comparable to each other. Management may have reason to be less forthcoming than they otherwise would be. And in fact, if we thought that principles-based disclosure just worked full stop, we wouldn't need an SEC or a 34 Act. We could just allow companies to disclose that which they would, which is a view that was advanced for many years in this country and rejected in 1933 and 1934 as a matter of federal securities law. So the question is, when you want information for investors, should you mandate specific measures or allow them to do whatever they want? My view, and the view that I think has prevailed at the SEC for the better part of 2 generations, is that the right answer is in between. That what you want to do, I think, is observe in the marketplace what measures, what specific metrics people and investors are using to evaluate firms and their conduct on certain matters. And then you want to mandate disclosure of those measures, followed by principles-based elaboration on a firm-by-firm basis that makes sense. That is my experience with the securities laws. And Doug, let me give you an example. One near and dear to our heart, an area of corporate governance disclosure that is not perfect, but has, for 20 years worked reasonably well, executive compensation. Executive compensation allows companies to write principles-based, very specific disclosure of why they paid their CEO the way they did, but also mandates disclosure of a table that tells you how much the person made. And I can tell you, having practiced in this area, people hate writing this table. They hate this table, Doug, because they know that that's the number that investors are going to look at. But you see, a lot of corporate lawyers view that as a bug. I think it's a feature. I think what it shows is that there's real accountability to investors with what you're doing with their money. I'm not saying the summary compensation table is perfect. I'm saying it creates a balance, an accountability as between principles-based and mandated measures. The problem with the SEC's recent SK amendments is that they're completely principles-based. There's not a single mandate in it. And investors and companies are going to be left to choose what measures they think most relevant. Now, it turns out, Doug, we're getting some leadership, if not from Washington, from BlackRock, who themselves have said that firms should be using the Sustainable Accounting Standards Board and European counterpart measures to think about ESG-related subjects. But you asked me, Doug, how companies are going to respond to this, and the answer is however they want, because there's not a single mandate in the entire document. I think they'll be able to provide principles-based, flexible disclosures that won't provide any comparable way of thinking about these issues for investors who are actually using the data. And essentially what we have is a private ordering approach to this disclosure.
But I guess one area where we might see maybe not standardized disclosures, but more is in the area of what's called, human capital or human capital resources, as is stated in the new rules. And you know, before this, the only thing you got in the 10K was, you know, how many employees do you have approximately? And are your relations with organized labor good? And so that was pretty easy disclosure to write about human capital. Now the SEC has actually responded to, you know, investor requests to have more, you know, well, some human capital disclosure. And also, you know, given what we've seen in just in this year with what companies are dealing with the COVID-19 pandemic and kind of all the implications that has on their workforce, you know, do you think we'll get anything, you know, meaningful out of this? I mean, what kind of things do you expect to see?
So it's a great point, Doug. And to be perfectly fair, guys, for the first time in this Reg SK analysis, the Securities and Exchange Commission has come forward and said human capital management and the company's approach to it is something to consider disclosing. Now, Doug, tell me, what exact measure has to be disclosed under these new rules? Do you have to disclose, for example, your turnover rate, how many employees you hire or fire, or the diversity of your workforce, or the number of women or men in your workforce? Or is there anything I can actually hang my hat on? Or do corporate lawyers just get paid to write disclosures? Now, look, before you answer that, let me just be clear. I want to confess my bias. I used to be a corporate lawyer who got paid to write disclosures. I now teach lawyers who will someday be corporate lawyers who are paid to write disclosures, and they should celebrate about the new Reg SK, Doug. But should investors?
I guess the answer is no.
Well, look, here's what I'll say. To the degree that US companies are getting pushed by investors and others to say more about human capital, they will. But I say with great respect, Doug, to you and to my former colleagues, I'm glad the SEC talked about human capital in that release. I'm glad that they suggested to companies they should be thinking about it. It's not obvious to me that well-governed companies in this day and age need to be told to think about it, but I see no specific measure, no way of thinking through what that means. Now, I want to say, just to be fair, that choosing that measure, Doug, is really hard. I don't know if turnover is the right number. I don't know if diversity is the right, how you'd even measure that. I think that those are really, really hard questions. But I wish the SEC had grappled with them instead of leaving that up to the market.
Well, I guess the good thing is they actually were willing to start the discussion. So that's you know, the sign that they didn't just completely blow off the investor sentiment.
I agree.
But you know, I'm kind of like you. If we don't really prescribe something, you only have a certain level of voluntary disclosure. It won't be standardized. So at the end of the day, you pretty much have to force people to do it. You know, we've all had the discussion with our clients. Well, is it legally required? And you say, well, no, but, and then that's kind of the end of the discussion because it's not legally required. So, you know, but like you said, there are standards that have been developed, yep. SASB, TCFD. Investors like BlackRock are really pushing for these, which is very significant. Yep. Can the SEC, you know, somehow like adopt those or incorporate them or, you know, simply recognize them like they have with other standards like, you know, the COSO internal control standards? Yep.
So let me say more about that, Doug, because you're absolutely right that there are now principles under which these questions have to be disclosed, and there's private innovation around what the right measures might be. And by the way, there's great research from a guy named George Serafin at the Harvard Business School who shows that in connection with the development of those measures, investors are responding. I mean, Doug, it turns out people really do care about this stuff. They trade on the basis of these kinds of decisions, on these kinds of measures, on environmental, social, governance-related measures. So I think, Doug, that we are going to be moving in a direction where the exact kind of systems you described related to internal controls, compliance, and what do we want to tell investors about how we're doing on these things are going to emerge. The only question is when. And the answer is I think they will emerge more quickly in companies that have management who are willing to do it, because even though the law doesn't require it, and investors who demand it, even though the law doesn't require it. And Doug, here's what I want to say about that. As a matter of securities law history, the reason we chose a mandatory regime in this country is because of a well-known economic problem that George Akerlof famously called the market for lemons. There's a selection effect when you don't mandate things. People who are very willing to disclose voluntarily will disclose voluntarily, but the ones that you most want information from won't, because the costs of revealing what they're doing are highest. And this is the case for mandatory disclosure. And this is why, Doug, the way I think of it is, there's sort of two extremes you can imagine when you're mandating, when you're handling disclosure. You can have a fully voluntary regime, which has the Akerlof problem, but avoids the cost of errant regulation. Or you can have a fully mandatory regime, which will make lots of mistakes and be costly. For 80 years, the truth has been in between. What troubles me about the more recent release is that there's not one measure. And I guess what I would say is, by the way, I'd be open even to a regime where you pick one today and reevaluate it in 3 years. Hear from the market, from investors about whether it was useful, about what the problems are, et cetera, and you continue to update and evaluate. But I think without some way to think meaningfully about accountability and measurement in the space, we're just going to get a lot of essays that say the right things, but don't move the ball as far as we could go.
Yeah, I mean, it'll be interesting to see, you know, maybe different industries are better than others. I also think a lot of companies, they would like some metrics. Otherwise, they have no idea what to write. They need a place to start.
Yeah, and I'll tell you, Doug, when I've talked to boards about this, both while I was on the SEC and since I stepped down, you know, I'll talk to corporate boards and they'll say, you know, Rob, one thing that would be beneficial about having a disclosure rule is we don't have to worry about whether our competitors will disclose. We know that we think it's the right thing to disclose the diversity of our workforce, and we know that our competitor will too. Whereas now the conversation we have to have with our lawyer is, look, it's kind of a principles-based thing. If we do it and they don't, does that put us at some way to competitive disadvantage? Are we revealing something that we shouldn't? Are we inviting the SEC to go further? And these are the costs of failing to move the ball a little further than my colleagues chose to do.
Okay, well, let's move on to talk about proxy plumbing, which is kind of like the dark underbelly of the proxy voting system here. You know, there's been a lot of talk about the proxy advisory firms and the shareholder proposals. Unfortunately, this morning's meeting to do something on that got postponed. But let's talk about, you know, the essence of the problem, you know, the system, that this crazy system that you've called Byzantine, you know, in terms of how proxies get voted with all these intermediaries.
Well, here's something that's really remarkable, Doug, and I know you know this because you've been studying and a thought leader on this issue for so long. But when I got to the SEC, guys, I discovered something remarkable. If a U.S. investor votes in a corporate election and just wants to call up and find out, was my vote counted? They can't get an answer to that. Like, that's not a thing you can do in America. Your broker or others who manage your money are not obligated to give you the answer to that. Now, I know, I don't want to be too on the nose, Doug, in October of a presidential election year about vote counting and such, but here's what I would say. It is, in a world with the technology we have, and the amount of money that is at stake in corporate contests, and the fact that we know that shareholders want to be heard on these issues, the fact that we don't know if their votes are going to be counted just won't do. And in 2010, the SEC did a wide-ranging concept release, a great study on this issue, Doug. Now, it's 400 pages long, and you will very rarely hear me say that any document that long is worth reading. That's not the Bible. But I will say that this thing is worth reading because it explains in detail how we got here. And the answer is the system of proxy plumbing, how a vote gets cast and counted, relies on a bunch of intermediaries who hold the shares in accounts, who can communicate the votes either to the issuer or another intermediary, eventually through a giant company named Broadridge that does most shareholder voting administration in the United States, along with other smaller firms. And the short version is that it is a total mess. And I am so proud of the fact that a number of leading firms came together last January, 18 months ago, to say we need help from the SEC on this. And really all we needed to say was the SEC needs to mandate that anybody providing services in connection with this has an obligation to be able to confirm how votes were cast. And the reason I was excited, Doug, is that this document came from Broadridge and the Society of Corporate Governance Professionals and people who, let me just say, a spoiler alert to the audience, don't ordinarily agree on contested matters of corporate governance. And the SEC proceeded for the next 18 months in light of this market consensus to do nothing. The SEC did not take action on proxy plumbing. And the reason is that the choice was made to prioritize regulation of proxy advisory services and certain limits on the ability of shareholders to vote on proposals. And Doug, we can debate the merits of that, but the statement you have in mind, the one you're quoting there, was my plea to my colleagues to say, look, I know there are advocates who would love for you to go after ISS or to make it really hard to make sure. I know that people are asking you to do that. Instead, start here. They disagree. They have more votes than me. That's okay. But I have to say, I think it's to the detriment of the commission and investors, because it will be the case, Doug, 12 months from now, regardless of what happens in politics. It'll be the case that 12 months from now, American investors can't get their vote, can't confirm whether their votes have been counted. And that's something we should fix.
So yeah, it's bizarre. It's kind of, it's the hanging chads of our financial system. But so some people ask, well, why can't the SEC just step in and just fix this? And my understanding is that it's not that simple. There are a lot of different parties. They're regulated by different entities. I don't even know if some of them are even regulated, and a lot of them are competitors. Broadridge is a public company. So, to what degree does the SEC actually have authority to do something?
It's a great point. And let me just, in response to Doug, who knows this area cold, let me just say, it's very rare the SEC can snap its fingers and fix a problem that's complicated. That's not how it works. The way it works is the SEC takes a step, and then the rest of the market responds to that step by solving the problem. So for example, Doug, just to take a disclosure example, mandated disclosure rule, the quality of disclosure is going to depend on what companies do. The SEC can't snap its fingers and fix ESG, nor can it do that in proxy service. What it can do in proxy plumbing is mandate that there be end-to-end confirmation of votes. Now, the way that will be handled is very complicated, involving competitors who might not agree, and some might offer the service and some might not, and there'll have to be follow-up and steps and communications with the staff for sure. But I will say this, we have at least 2 decades of experience with what happens in this area when you do nothing, which is nothing good. Which is why it was such a shame, I thought, that rather than pursue it, my colleagues prioritized other matters.
Now, so we have a number of people on the line who are very interested in fintech. And I know next to nothing about fintech, but I know there's something called blockchain technology. And, a lot of people have thrown out the idea of, well, is there a role to play? Could blockchain be part of the solution? It seems like it would fit in terms of, chain of possession in terms of the shares, the votes, etc., that you should be able to use this technology to set up some pretty easy way to do end-to-end vote confirmation.
Yeah, so it's a great, so first of all, I don't know about you all, but one experience I had on the SEC, of all the things I thought were going to come before me, I didn't think like blockchain was going to be like, I didn't think this was going to be, and not only that, Doug, I don't know about you, once I learned about it, I had an expert at the SEC come in and help me understand it. What I learned is that blockchain is this unbelievable technology where you can meaningfully audit transactions, like step to step, you can confirm their veracity using millions, billions of people's labor and incomprehensibly strong, powerful computers. Very exciting. Doug, I don't know about you. My first thinking of the application of this was not that it was going to be used to invent new money. We have money. It strikes me as imperfect money for sure. We can debate that, but I didn't think it'd be like, I thought this would be a good technology, for example, for audit. I could imagine accounting firms automating a lot of what they do.
Yeah.
And I agree with you, Doug, that another place that'd be very powerful would be voting. And in fact, it's my understanding that some of the leaders in the space, including Broadridge, have invested considerably in blockchain technology that could be used in connection with shareholder voting. But that's another good example, Doug.
Yeah.
Because the SEC would need to signal that using that technology in that way would not generate additional liability. Now, I hope that my colleagues are working on that. I think they don't want to stifle this innovation. I know some of my former colleagues in particular have been pushing on that, and I support that work. I think we could make shareholder voting easier, cheaper, and more accurate. I'm all for that. But I will say that that's why doing nothing is such an unlikely strategy. It's not likely to succeed.
Yeah, yeah. Well, we, you know, the chair of the steering committee for this center is the general counsel at Ripple. Unfortunately, he was supposed to be here today, but he had to get pulled away.
I am
here.
here.
You're there. Oh, I'm sorry.
here.
I'm sorry.
Yeah.
So
Yes.
I don't know, Stu. You know, you want to get in on this discussion, or just in general on fintech or blockchain technology? I know you've got some things on your mind that maybe Rob can chime in as well.
Sure. Well, thank you, Professor. As the chair of the center, this is wonderful that you're taking your time to do this. I think these conversations with thought leaders in the profession are incredibly important even in sane and normal days, and they're even more important in the days of kind of lockdown and social distancing and sequestering, because we need to stay connected as a legal community, so we keep thinking about issues that are forefront on our minds. So thank you so much for doing this. After having sheltered in place for 6 months in my home in New Jersey, I actually did get on a plane, and I'm sitting at Ripple's offices in San Francisco. Our CEO finally said, look, after 6 months, we just need to get the leadership team together for 2 days and just talk. So we did that, very socially distanced, six feet apart of everybody with microphones, but it was incredibly invigorating. But sitting here in San Francisco, in kind of the center of Silicon Valley and innovation, I did want to talk about the intersection of innovation and regulation. And we've talked about blockchain, and look, I come from the East Coast, traditional banking, blockchain and digital assets were not a twinkle in my eye 2 years ago before I joined Ripple. So this is new, I think, to all of us, but I think it's the innovation, the momentum behind the innovation and the inevitability of this innovation has just really been overwhelming, given my time here at Ripple. Just yesterday, the SEC announced yet another enforcement settlement against a digital asset company, and I don't want to talk about the specifics of that, but Commissioner Peirce was very prompt to publish her dissent from that, and it was a poignant dissent, and the fact that Commissioner Peirce has voiced her views on digital assets and the SEC's approach is not a surprise, but I did find this dissent particularly poignant, because what she said is essentially that she fears that the SEC is going to be on the wrong side of history when it comes to innovation. And I'll just quote one line. She says, by failing to challenge ourselves to experiment with new approaches to regulation, we and those whose interest we are pledged to serve risk surrendering the fruits of that innovation. So my question to you is general, not to talk about the specific case. But how do you think about whether it's the SEC's or any regulator's approach to innovation and the intersection of regulation, with the innovation being so new but so powerful, and regulation, being 70 or 80 or 90 years in the making? How do you marry the two so you're not sacrificing the innovation, but also you're also not sacrificing the policy goals of the regulation?
Well, Stu, first of all, thank you both for the question and for your leadership here at Rutgers and at the center. And you are very much at the center at Ripple of this new generational technology. I'm really excited to see what's next in this incredible space. First of all, let me start by saying, Commissioner Peirce is one of my most brilliant colleagues I have great affection for her. I'm still in touch. I was delighted that she was confirmed for another 5-year term on the commission, along with my former counsel, now Commissioner Caroline Crenshaw. So Stu, here's, I want to break down your question for our colleagues, and I'm going to have a question for you in a moment. So Stu's question is, Rob, on the one hand, we want to be sure not to be on the wrong side of history, as Commissioner Peirce put it, or if you prefer, we want to be sure not to stifle innovation. That's very important. We should be encouraging innovation, for sure, Stu, no one's against that. On the other hand, we're against fraud. And to the degree that this technology is being used to dress up old tricks and like defrauding investors or pump and dump schemes into new technology, we don't want to be fooled by the new clothes. And I think what I've said so far, we all agree on. So here's my question for you. How do you do that? And my answer is that regulators do that by being in touch with the market, hearing what's happening, and helping the market work with the regulator to distinguish fraud from innovation. That's how it works. And I can tell you right now, when I was an investment banker at what used to be called Bear Stearns, not my fault, I can tell you right now, we would call the SEC all the time and say, here's our registration statement, here's what we're thinking of saying, and they would say, don't say that or say this. And we would, Stu, you know the name for this, right? We call this guidance. Regulators provide guidance that helps the market understand where to go. Now, Stu, you would think from the passage you've just read in my colleague's dissent, that she and others like them would be a big fan of guidance, because this would be a way for you at Ripple and everyone else to understand what regulators think the law is. So is it your impression that my former colleagues on the SEC, Commissioner Peirce and friends, are very pro-guidance?
Well, I do. And in fact, her tweet, and in our world, everybody tweets, but her tweet, which accompanied the publication of her statement, she said, isn't it really time for us to provide some guidance on this issue?
For sure, but what here's the important details to. In a speech about 2 years ago, Commissioner Peirce, called SEC Secret Garden,
yep.
He objected to guidance because it is errant staff rulemaking. It's lawless law. And in fact, this administration has put out a document saying that we can't give guidance anymore, that it's athwart like the I don't know, Article 2 or something, you know. So look, here's my answer to you, Stu. They can't have this both ways, man. Right? Yeah. You can't say that, no, you can't guide the market, but also no, you can't enforce the law. Because Stu, when I voted for these enforcement actions, I'd get big lectures from lobbyists about regulation by enforcement. But then I try to give guidance and they'd say, no, don't do that either. Now, what that means to me is that really what people want is not to be regulated. And that's where we part ways. Because actually, I think it's better for an emerging technology like this to set some standards. And Stu, I know you agree because you work at Ripple, one of the leaders in the industry, actually one of the firms that has been crucial to the forming of standards around the various securities law questions, et cetera. And how did we get from here to there? Because you guys can call Hinman and Val and all the other amazing people who do what they do and get answers to your questions. And don't have to have an APA open meeting every single time you want to know whether or not you guys can do something. So here's what I'd say with great respect to my former colleagues. There, occasionally, the ideology on this question overwhelms the practicalities. As a practical matter, Stu, the only way for us to get to the place you want us to go is for the regulators to work together with the market through guidance. This is an area where my colleagues should be delighted to welcome it, rather than lecture SEC staff, who are incredible public servants, about doing their job.
So thank you for that, and I'll yield the floor back. With one final comment, that was incredibly helpful, Professor. As you know, and you've already acknowledged, Ripple has been on the forefront. I think the reason they hired me, who spent over 30 years in traditional banking and traditional law firm on the East Coast, is to help push the regulatory agenda. And I travel the world, or at least now I travel it virtually, meeting with central bankers and meeting with regulators, begging for regulation. Whereas when I was a general counsel for a bank, I used to meet with the central bankers and regulators asking for regulatory relief. Here I'm saying, give me the regulation, let me know what the rules of the road are. But I do think the issue of practical guidance, which we've seen in Singapore, we've seen in Japan, we've seen in the UK, we've seen in Switzerland, the US is starting to feel that they are a half step behind, but we'll continue to push the issue. And I agree, what we need is clear guidance and regulation, so we know what I think we know what bad looks like now. I think it'd be helpful if we know what good looks like. But thank you very much for your time.
Well, no, Stu, let me just say that is extremely well put. And just between you, me, and the 70 friends on the phone, let me say that, I read Hester's statement. I understand where she's coming from, but you saw that what she really is advancing is a 3-year safe harbor from the securities laws for this kind of stuff.
Yeah.
Stu, man, like, first of all, it's going nowhere in Congress, number one. Number two, I don't actually, hearing you out, I don't think you want it. And with respect, you know your business better than I do, I don't think you should. Because you guys have spent the better part of the last several years hiring industry thought leaders like you, Stu, to figure this out and do it right. Why do you want to turn it into the Wild West? I don't think you do. I think what you want to do is make it a serious U.S. regulated, an area where the law is understood and followed by folks like Ripple, and where you don't have to compete with fly-by-nights who refuse to obey the law. So again, with great respect to my former colleagues, I agree with you, Stu. I think what is needed is regulatory leadership here. That requires us to be flexible and have guidance. Because, so I got to tell you, when I got to the SEC, people said, why don't you make a rule on crypto or ICOs, et cetera? My answer was, by the time we propose it, get comments, finalize it, get sued on it, and win, the regulation we wrote will be out of date. So instead, the way to do it is with the flexible, nimble guidance that people have been using since I was on Wall Street. And that's where I think Hester and I might see this a little differently.
Very helpful. Thank you.
Thank you.
Yield the floor back.
All right. Well, that was great. So, Rob, we cannot leave without discussing political contributions or disclosure of political contributions. Now, I guess it's been like 10 years since the original petition for this, and the millions of comments that have streamed in, basically agreeing with you, saying, yes, companies should be required to disclose how much they spend on, for political contributions to political campaigns specifically. In those intervening 10 years, there have been a lot of shareholder proposals. There have been a lot of discussions with our friend Bruce Freed at the Center for Political Accountability. And there's been a lot of voluntary disclosure in this area. Obviously it's not universal, but it's come a long way. And so, you have some ideas in terms of what happens next. And I know you've discussed this with Congresswoman Waters at length. So why don't you give us a little bit of what you're thinking about right now?
Yeah, sure. Happy to talk about it. So, so for those who aren't familiar with the issue, about 10 years ago, it was like, if you look at this document, it's like me and 9 famous law professors petitioned the SEC to make a rule requiring mandatory disclosure, companies to disclose when they use shareholder money on politics. And here was the theory of the proposal. Citizens United was decided and provided a rule that corporations have a constitutional right, more or less, to spend shareholder money on politics. Not always been the rule, but it is now the rule. And it's very clear that corporations give very large amounts of money to large intermediaries, and the biggest ones are well known in Washington: the American Petroleum Institute, the Business Roundtable, Chamber of Commerce. And these intermediaries turn around and take $300–400 million of shareholder money every 2 years and provide indirect support to particular political candidates. By the way, on both sides, the Chamber of Commerce, Doug, you might have seen, endorsed a bunch of Democrats a few months ago. It's not just a question of Republican versus Democrat. So my view was, anytime we have managers who can spend shareholder money in a way that might not align with shareholder interests, we require disclosure of that. That's why we require disclosure of who's on the audit committee, why we have disclosure of executive pay, why we have disclosure, all these things. It's just a conflict transaction. And Doug, my fundamental argument here is that the politics of the CEO might not be the same as the politics of the investors. If you believe that, I think it follows rather straightforwardly that there's a conflict issue here and that there should be disclosure. So here I am, innocent law professor, sitting in New York with an idea. I write this proposal, and a couple of years later, more than 1.3 million people had written to the SEC telling them this petition's a good idea, you should make the rule. But there are people who disagree with this, and they're called congressional Republicans. They added to a rider to the SEC's budget. And I got to tell you, Doug will tell you, I was a kid born in the Bronx. So for me, this is like actually kind of fun. Congress passed a rule saying, here's the SEC's budget. It's $1.3 billion, and you can have it all so long as you don't spend it on Jackson's idea. So I took this as the punch in the face that I thought it was, and became an SEC commissioner, and then testified in front of the Congress that this to me actually shows that we were probably onto something. That fundamentally people who are opposed to this are opposed because of for political reasons, not for others. Now, to be perfectly fair, there are good arguments against this proposal. They're just not the ones that that have been advanced in Congress. Instead, they're ones that have been advanced by brilliant colleagues like Doug or other folks who've long been in the corporate law field. And the arguments against this go something like this. Rob, you don't want to have to disclose this because it might not be material. The amount of money that's spent on political spending may be relatively small in the overall budget of these firms. I have answers to those arguments. We disclose even small amounts of executive pay, even though they might not be material from a financial point of view. Materiality is not merely quantitative, it's also qualitative. I've got answers, but these are things about which reasonable people can disagree. What I'll say is, I think, Doug, in my view, the last 10 years, the case is much stronger now than it was 10 years ago. Why? Because shareholders increasingly are voting for proposals in this area. It used to be that shareholder proposals requesting disclosure of corporate spending on politics got between 10 and 15%. Doug, I don't know if you saw, several of them got majority support this past year. Now, I don't think the SEC should only mandate disclosures for things that have majority support. But I think that there's a very good argument that investors want this information. So, Doug, my own view, Stu was asking what it would be like, whether I'm worried, whether regulators should worry about being on the wrong side of history. I am confident that the arc of history in this area bends toward more transparency, not less. I like the side I'm on this debate.
So now another part of the discussion, and is spelled out in your letter to Congresswoman Waters, is the criticism that the largest asset managers in the country that own and control 20 to 25% of the votes at S&P 500 companies, in the aggregate, they generally vote against political contribution shareholder proposals, and your analysis has shown that it's basically never. They never support these things. And so, but so isn't that an indicator that, if the big mainstream investors really don't care, and they've told us they don't really care, and it's not like they're kind of, on the side of one party. These are the same people pushing climate change disclosure. What if they actually don't care,
Very fair question. As Doug points out, BlackRock and Vanguard have never voted for transparency of corporate political spending. Doug imagines that this is because they've carefully analyzed the issue and concluded that it's not important. Doug, is there another possible explanation that you can think of?
I was
spitball with me. I'm a professor now.
Well,
could it be
I
that
guess,
it's not to their personal political advantage to vote for it, maybe?
Well, I don't know. I mean, if Larry Fink wants to become Treasury Secretary, he's there's,
We'll see. But fair enough. Let me just make it one more point about this, Doug, which is in the letter to Congress that I wrote while I was on the commission, I was making a slightly different point, which is Vanguard and BlackRock don't vote for this stuff, and they don't disclose to investors that they vote that way. And Doug, with great respect to my friends at BlackRock and Vanguard, I think this is a serious problem. If you go onto their website and look for their principles, they say we vote on proposals in this area on a case-by-case basis. Sometimes they're good, sometimes they're bad. And that strikes me, by the way, Doug, as an eminently reasonable view. But Vanguard has voted against more than 850. They're 0 for 850. That ain't case-by-case, man. They've decided to vote against them. That's cool. You're right. They're entitled. They should disclose that fact. And I wonder, Doug, why they don't. What I was pushing them to do was say, look, man, update your perspective, update your disclosures. Just tell investors, we don't believe that you should be able to see when companies spend your money on politics. If investors give you money, notwithstanding that, that's none of my business. I'm happy with that.
And so, at the beginning of the discussion, you pointed out that, some of this is related to the Supreme Court decision in Citizens United case. So after that case, we had the proliferation of what's called super PACs and dark money and all of this kind of stuff. And I guess, at least the data I've seen is that the companies are not giving directly to the super PACs, but they're doing what you said in terms of, okay, they're giving a ton of money to U.S. Chamber of Commerce, National Association of Manufacturers, Pharma, all these these industry groups, and then those groups give it to the super PACs. But at a certain point, the company, they want to participate in industry groups. It's important to them. Mm-hmm. And so, so they pay membership dues to these organizations. Yep. Why do they have to publicize them? And what are they going to do? Why don't you regulate the U.S. Chamber of Commerce and make them disclose this stuff? Because the companies, they can't control what those organizations do.
Well, first, Doug, just to be clear, any company that gives money to the chamber can specify what it can or cannot be spent for. And many do that. Many people say you can use this for education, but not for politics. But put that to one side. Doug, here's my answer. When the company hands that money to the chamber, it's not their money. It's shareholders' money, man. And just as a general rule, if you want to spend someone else's money on your politics, that's cool. Just tell them. Now, we can debate, by the way, whether it's actually okay to spend someone else's money on politics. In fact, people should know that there's been a law in the books in the United States called the Tillman Act for more than a century that prohibits direct corporate contributions to campaigns. That's why they have to go in this roundabout fashion that Doug correctly described. What I would say about this is, I got to say, Doug, I understand why people want to participate in industry groups, but they know it's not a secret to anybody in corporate America what the chamber does with this money. They know where it's going. Just tell the people whose money you're spending how you're spending it. If you're comfortable with the spending, you shouldn't have any difficulty disclosing. Here's another example, Doug. When we mandated disclosure of executive comp, okay, at the time there was a rulemaking on disclosing the amount of money the CEO makes. And many people complained, if you require this, companies won't pay the CEO what she's worth because they'll be embarrassed, too afraid to disclose how much the pay packages are. Doug, how'd that turn out?
Like I tell everybody, you cannot shame the shameless.
So here's my thing. When I talk about disclosure, I think some people are worried about it. Honestly, not you, Doug. You're an analyst of these questions. Some people are worried that if you disclose this kind of stuff, it will disappear. I'm not at all convinced of that. That's not what happened with executive pay. It's not what's happened in other areas. I actually think if you disclose it, you might get more spending in politics. Just like we did executive compensation, because people will take the disclosures and use them to ratchet up other people's spending. It's not, all we'll have is some accountability for it. That's what I'm for. I'm a shareholder rights guy.
So a number of shareholder opponents have now kind of moved into the area of lobbying spending. Mm. Do you see that as all part of the same ball of wax, or is lobbying a very different area that is somewhat, there is disclosure there, and, it's not giving money to people's campaigns. It's actually lobbying on the Hill on legislation. So how do you look at these things?
Totally different. You are 1,000% right to push me on this, Doug, and that is the limit of my argument. My argument is an alignment between management and shareholders whose money. I'm making an agency cost argument, right? If I have reason to suspect a divergence in their interests, as I do on politics, because I don't think shareholders buy shares based on politics, right? So because I think there are two different there conflict of interest there, I have a case for a disclosure rule. As to lobbying, I don't have that argument, Doug, because both shareholders and management want rules that are more lax for the company. I might be against corporate lobbying, but I can't make the same arguments here, and I won't. So when people have asked me to come out and say, no, we have to stop corporate, I don't sign those things, man. I don't say that, because my argument doesn't go that far. My argument goes as far as agency costs will take. On politics, I'll give you another example. People say to me, Rob, if you're for these disclosures, shouldn't you also be for disclosure of corporate charitable contributions? Absolutely, and I am. Even though, I want to point out, some corporate charitable contributions go to universities where I work. Them's the breaks. My concern is that management might be spending someone else's money in a way that someone else would not want. With charitable contributions, the CEO's favorite charity might not be the shareholder's favorite charity. So I am committed to a rule that would shine light on these things. And I don't have that argument when it comes to lobbying. So Doug, one of the things that's been frustrating for me is if I had come out full bore and said, stop all corporate spending on politics, then my opponents would be right. Then they'd have an argument because that's not the role of the SEC. But the rule we focused on was very narrowly tailored at a particular conflict transaction that corporate law has regulated for many decades, which is why I think in the long run of life, we're going to win this debate.
All right. Well, we've talked about a lot. Any questions? I don't see questions pouring in written form.
Well,
I don't know.
We did get one, Doug.
Sorry?
We have one here that I can see.
Oh, okay. Yeah. We do have one. So, yeah, this is kind of a long one. I mean, I don't know if everyone can see it.
I'll tell you what. I'll read it, and then others who have questions, please go ahead and chat them into us because we're happy to. Really want it to be an interactive conversation. I love talking at Rutgers because you guys have so many people out in the field who are doing cool stuff. So, the question is, both it's coming from someone who I think is at a company, a public company, and they say companies would benefit from standardized disclosure. It would actually be more efficient than less efficient. So, who stands in the way of the SEC mandating disclosures? This is a straightforward. The answer is politics. It's just not, Republicans are not persuaded that these kinds of mandates are efficient, are good. And by the way, I say politics, but I don't want to denigrate people who, it's not raw, it's not politics, it's a different way of thinking about securities law. Many Republican members of the commission are convinced that private ordering is the more efficient fashion of arriving at disclosure mandates. By the way, there's a lot of basis for that rule. For that view, I'm not disagreeing with their idea that there is that concern. I'm just saying that the mandates would be helpful in the way that the questioner is asking. I will say one more thing. In this area, every once in a while, people tend to reach for more rhetoric than the facts can sustain. And when that happens, I regret it because I got to be honest, of all the things the SEC could offer to America at the moment, I think more vitriol is not what we need. So, for example, I have a former colleague. One person gave remarks suggesting that if the SEC were to promulgate rules governing environmental disclosure, for example, that anyone voting for such a rule would have breached their oath of office because they would have been bringing their personal views to SEC rules. Now, look. We can agree or disagree about whether these rules are a good idea, but no one's breaching any oath of office by pursuing them. And I think we should have like the reasoned debate about mandatory versus voluntary disclosure that we've been having for 80 years, instead of yelling at each other, saying things that really don't make much sense.
Yeah, we're definitely long on vitriol these days. Just I guess maybe final question, since you're from the Bronx. Do you think that Gary Sanchez still will be the starting catcher for the New York Yankees when he's only batting 126?
Listen, Doug, this is a huge problem. How much time do we have? Like, this is a huge problem. We can pour beer and talk. First of all, seriously, Doug, do we have a few more minutes or no?
Professor Eakley, it's
absolutely.
Lovely. Okay, good. Because we're getting a couple more questions that I'd like to answer.
We just had another question. Yep.
I saw. So yeah, but let me answer Doug's because it's very important. A few things. First of all, watching this baseball season has been extraordinary. I never seen anything like this in my life. I've been watching baseball since I was a very little boy in the Bronx. To me, what's interesting is to see how teams are adjusting to the rules have changed. Baseball tends to be, from an economic thinker's point of view, a high-end game. That is, there's so many observations in a baseball, 162 games. There's so many observations in a baseball season that you can have faith that if your team is better in the long run, they'll perform better because there's just so many games. That's changed. It's a shorter season. And so we have a small sample results, like the fact that the Yankees, are not that much better than the Mets, which, just can't be true in the long run of life, but is true in small samples. One thing I'm interested in, Doug, is that the Yankees have put a lot of guys on the injured list who are just now coming back. They are going to be a much better team next month than this month. And in this short season, that's what you want. Like, their strategy is rational, because all you need to do is make the playoffs. And then you've got an expanded playoff format, and what you need to do is get hot in the playoffs. And Aaron Judge is back, Giancarlo Stanton is back. But Doug has raised the serious question as to whether Gary Sanchez can be our full-time catcher of the future, as many hoped he would, if he keeps hitting like this. And the easy answer to that is no. And I want to tell you, Doug, that just before this call, I was speaking with some of the relevant officials, and they wondered if you'd be willing to suit up. So I had the plate in the Bronx, because really, let's face it, Doug, with all due respect to Gary, I think you'd probably be the better hitter at this point.
Well, maybe not me, but definitely my son. But so we have a question coming in from a Met fan. Rob, I will give you the option of whether to actually acknowledge this question.
Well, first of all, let me just say, any Met fan should be congratulated for favoring hope over experience, which is a triumph of the soul. First of all, no shame in that. I'm a Jets fan because my father grew up around the time of Joe Namath. So look, I don't take it personally. At the end of the day, I could either be a Jets fan or find a new father. It's just easier. Come on, like, what are you gonna do? So I totally hear you. I understand. By the way, I got married last year. And my best friend who actually introduced me to my wife, he arranged for me to throw out the first pitch at Citi Field, which was a very, very cool experience. And I can tell you what. But anyway, your question is, many companies are actually requiring employees to vote for certain candidates. Should this be covered by my disclosure rules or just money? Great question. Great question. So the questioner is really asking, guys, whether or not, how you can scope my disclosure rule. Because what's the difference between taking shareholder money, a check, and shareholder money that paid for an employee? And by the way, you could keep going further down the question. It's an excellent question. You go further down that line. What if they allow use of company space that was paid for, the rent is paid for by shareholders? On the other hand, what if the place is not going to be used and it's a place they own? It's very common. So let me just say that I agree that those questions are hard ones that would have to be worked out in SEC rules. Which is why I've been a little disappointed that my colleagues haven't been willing even to start that conversation. Because full transparency, I'll tell you, if I were making the decision, you can't snap your fingers and make that rule. No. That takes like a year of consultation with the staff. You need to get feedback from the market. You need to do a proposal. You need to get comments. Which is why I think the journey from here to a rule that actually helps companies rather than distracts them or is counterproductive is a long journey, which is why the SEC should get on that road. It should have many years ago, because it takes a long time to write the kind of rule that makes the distinctions you're talking about.
So Matteo, you referenced this, I guess in Matteo's question, he says that companies are essentially forcing their employees to either campaign or vote for certain candidates. See Hertel Fernandez, Politics at Work. If you could send me that article, I'd love to see it, because I've seen companies come close to doing it, having very suggestive measures, but I've never seen any company actually force people to do it. But then again, there are definitely bad actors out there. So,
Doug, we're just about out of time, but there's one other question from Les Silverman at Cleary Gottlieb in the chat box. Maybe
okay.
In for a minute or two.
Okay, so Les, not sure how principles-based disclosure can reasonably be called voluntary disclosure when there is securities law liability for an omission that makes what it said misleading. Doesn't that put teeth in so-called voluntary disclosure?
Les, how are you? Oh, we can't see each other. Les, great to hear from you. I know you're out there somewhere. It's a fair question. Les is saying, look, Rob, it's not really voluntary disclosure, because companies that fail to say something important can get sued and lose. A few things about that. First of all, I think the securities enforcement regime is not perfect. So so not every omission will lead to the kind of suit that puts teeth into the rule you're describing. But I know you're not going to agree with that argument. Let me try one on you that I think you will agree with. The economics of plaintiffs' lawyers do not involve identifying the most important omissions, the ones that actually put teeth in a voluntary principles-based disclosure regime. No, Les, I'm sure you'll agree the economics of people who sue companies for a living are to bring cases that involve major stock price changes that can survive a motion to dismiss and generate a settlement. Now, whether or not, I'm not judging that, I'm just observing an empirical fact about the world. I do not want to rely on that system to define the securities laws. By the way, neither do my colleagues. That's why they tell me they're against regulation by enforcement. Here's my point, Les. You can be against regulation for enforcement or against regulation, but not both. Or if you prefer, that just makes you against regulation. And hey, that's cool. But then if you're against regulating securities, you're kind of for securities fraud. And I just feel like we should be intellectually honest about these choices. There's no free lunch here. It's not that we can tell companies do whatever you want and leave it to the market to create efficient securities laws that the SEC won't make by suing. I think if we go that way, there's going to be real costs of it. And that's why I wanted my colleagues to go further than merely saying, I mean, look, Les, on that argument, you could have a principles-based balance sheet, a principles-based income statement. You know, every company's different. Wouldn't want to mandate one size fits all. So those numbers, you know, it's all really complicated. You know, just write us an essay about how it's going. You know, on that theory, you could do a lot that's principles-based, but we don't, because the right mix in securities law is to balance these two things. And that's a balance I wish my colleagues would have struck differently in that particular case, but I hear you.
Well, this has been a wonderfully insightful, wonderfully informative, wonderfully entertaining conversation. And Rob, if I may call you Rob, thank you so much for joining us this evening. And Doug Shaw, thanks so much for helping form the conversation.
Absolutely.
Thanks so much, everybody. Yeah. What a pleasure. Doug, I'll look forward to our next conversation. I'm telling you, one of these days, Doug, I'm going to convince you on political spin.
It'll be over beers at Yankee Stadium. I
Good
promise.
Deal.
I promise.
Deal. Thanks, everybody, for the
All right.
conversation.
Good night.
All right. Thank you, everybody.